Welcome to Without Boundaries, a podcast from Russell Investments. We're here to talk with the people behind the portfolios, the active managers from all asset classes who shape how markets move in the real world, and who help us improve financial security for investors around the globe. I'm your host, John Eggins, Head of Portfolio Management here and a Russell Investments lifer of 23 years. We know that the best ideas don't just come from a single source. That's why we look far and wide, spanning markets and asset classes around the globe to find the most compelling managers and insights. Today, we're in beautiful Sydney, my hometown. So we're actually really going without boundaries for this episode. We're crossing hemispheres to bring you a story from really the other side of the world where most of you are listening from. You might have picked up on my accent. Although I've been living in the US for 17 years, I do get told that it's not as pronounced as it used to be. My family and friends make fun of me. Still, Australia is home. It's where I started my career at Russell Investments as an intern. And we've been working with clients and partners here for over 40 years. We're talking with Choy, the CIO from Coolabah Capital Investments. Coolabah runs around $15 billion. You can correct me, is it higher or lower than that now?
About 15 billion.
About 15 billion. So Chris and team founded the firm in 2011. And this is a really interesting, unique firm. You seek to generate security selection alpha by exploiting mispricings in liquid high credit strategies and sovereigns around the world. Coolabah's approach is really also quite different. Rather than relying on big bets on duration or on credit, it's all about idiosyncratic or security selection risk. So we're going to spend a lot of time focused on that today. Before we do, though, I wanted to let the audience get to know you a little bit better, Chris. So I grew up in Sydney, in the Sutherland Shire. Where did you grow up?
I grew up in Sydney, in the eastern suburbs, and then I spent 3 years at Marlborough College at school in England, in Wiltshire, then came back to Australia, and then was sent down to school in a state called Victoria. Spent my final 2 years there. I went to Sydney University and then Cambridge University. First job was at Goldman Sachs in London. Funnily enough, I was hired into Goldman Sachs, not to name drop, but by the chairman of Goldman at the time, Malcolm Turnbull, who became our prime minister.
Oh, Matt, yeah. Oh, a very famous name here. But yeah, former prime minister. Yeah.
And he was chair at Goldman at the time, and he hired me into Goldman. And I started at Goldman in London in M&A and did a little bit of work in the principal investments area as well. Basically an Aussie. By the way, I think your accent's more or less unperturbed. It sounds pretty robust.
No, you're being very kind. I went to the University of New South Wales, so kind of a rival institution here, and played Australian rules football.
Oh, wow.
So I'm guessing I never played against you, though, because you seem to have some kind of connection with rugby. So did you play, and what's with the sponsorship of the Crusaders? And yeah, tell me more about that.
Rugby was my thing at school. I was super passionate about it. We've actually appointed the former Australian captain, Phil Kearns, who was a hooker. I was a hooker.
Oh, yeah.
I'm about 105 kilos, a bit pudgy, and pudgy guys seem to be at the front row of a rugby scrum. And so Phil sits on our board, and I love my rugby, and I wanted to play for the Wallabies, but I did kind of captain my state at schoolboy level. But I basically stopped at school level.
Okay.
The university was all about academics. And we have a lot of connectivity with New Zealand. I love New Zealand.
Yeah.
I'm passionate about heli skiing, and I spent a lot of time in the South Island of New Zealand. And we have a global business, a lot of increasingly global investors, and we wanted to globalize the brand. And I was actually thinking about sponsoring the All Blacks. Yeah. And I had a great conversation with the All Blacks. The Coolabah name comes from the native Australian tree, which is a very durable and resourceful specimen used by the native Australian population for lots of different medicinal and other purposes. And I said to the All Blacks, Australia and New Zealand have this huge rivalry. The All Blacks are the New Zealand national side. And I said, what about putting this native Australian tree?
Well, you can't do that.
Well, the funny thing was, they were like, because I said, listen, we are pretty much the fastest, highest velocity credit traders on the planet. We have spectacular win ratios. The All Blacks, similar, they have like an 80% win ratio. And they said, yeah, no problem. We'll put it on the front of the jersey. And I said, well, how much would it cost? And they said, it's only $40 million a year. I was like, whoa, I'm just a boutique bond manager. We don't get paid much. That's not going to happen. And so for a tiny, like fraction of that sum, there was a team that was struggling, which is Crusaders, which were the most winning provincial rugby team in the world. They won 7 consecutive titles, but they were really struggling. They lost all their players, lost their coach. and we sponsor them.
That I'm really glad you described where that name came from. It's a very special name to me because even though I live in the US, I sing Waltzing Matilda to my girls before they go to bed.
Oh wow!
And as you know, one of the lines is under the shade of the Coolabah tree. So it was very when we started working with you guys, I had to explain to everyone how to pronounce it and what the name meant. So I'm glad I finally got it.
Why did you start Coolabah back in 2011? Yeah, I mean, there's a short story and a long story. The short version would be that we identified this massively inefficient asset class, which I can explain. The longer version would be something along the lines of, I never expected to be a bond trader. I was always going to be an M&A guy, principal investments guy. And, when you're at university, as we were, like working for Goldman Sachs in M&A was the highest paying and best possible opportunity you could get as a graduate. So that's the way I saw my kind of life unfolding. The truth is I set up a fixed income business, a quant investment management business that I sold to Macquarie Bank. And we found it was a very intellectual property intensive business, but it was very hard to scale. So we could only raise a few $100 million. And I was looking for a more scalable opportunity that was more sustainable. And we set up Coolabah to really exploit inefficiencies in dark, opaque OTC credit markets. And OTC bonds are endlessly fascinating. They sound boring, but they're endlessly fascinating because it's like the final frontier for inefficiency. And everyone overlooks it. And our philosophy or view is that everyone gets fixed income wrong. They try and get alpha out of the efficient parts of the market. Listed interest rates, futures, derivatives, active duration management, FX, credit default swaps, all the hyper-transparent, liquid, and often exchange intermediated parts of the market. And they kind of neglect their bond books, the physical bond books. And what we felt was that with the global financial crisis in 2008, the market makers were shut down in terms of prop trading and principal investing. You had the Volcker rule and the Dodd-Frank regulations.
Right.
And the banks couldn't take much risk in bond trading any longer thereafter. And so the bank market makers went from being principal traders to brokers matching buyers and sellers. The value of high-grade credit outstanding exploded from 2008 through to today, but the banks shifted their business models. They make all their money from debt advisory, from DCM, from debt capital market work. If you speak to banks these days, they'll always say the same thing. We really don't make much, if any, money from bond trading, and we don't resource it because we're not allowed to put much balance sheet capacity into that space. And then we looked at the bond managers. Our view would be that they're hold to maturity, buy to maintain. The bond books are relatively static. I remember speaking to the head of portfolio management at one of the biggest fixed income firms going around, and he said, "What are you doing?" I said, "Oh, we really actively trade credit." And he goes, "Why do you do that?" I said, "Well, there's so much alpha."
Yeah.
He said, "But there's no alpha in credit trading. That's your beta book. That's your yield. That's your carry." And I'm like, "Well, how do you guys get your alpha?" He goes, "Well, obviously from duration FX CDS." And so I think everyone's got to ask about. I think they've got it completely wrong. And we've got now probably close to $500 billion worth of trades in physical bond markets to show how inefficient the opportunity set is. And bizarrely, we don't seem to have any competitors globally. I talk about it pretty openly because we've got high conviction in the durability of our edge. That's why I set up Coolabah.
Our experience on the manager research side, I don't know if you've heard Adam, our research head, talk about this as well. But what we hear from others in the market occasionally, they'll say something like, "Oh, is that crazy Aussie shop that's out there trading bonds so efficiently?"
I'm so glad you said that. It's super cool.
Yeah, no, that's it. And I was wondering, does that seem too much or about right? And
no, that seems totally right. And so right. I actually
and I think the craziness is about the amount of turnover. So tell me about how and why that level of turnover is productive and efficient. I guess would be here. But if you have more comments on the crazy comment, share that too.
Yeah, I actually say to clients that it's interesting. I thought Russell was super innovative, Russell was very interesting for us to engage with because you guys got us straight away. With Adam, the first meeting I had with your manager research team, he more or less opened up by saying, "We are really interested in over-the-counter credit for the same reasons we were. This is not traded on a digital central exchange. It's not like shares. Credit trading is like trading shares before stock markets existed. There's really no algos. There's no quants. It's all a voice market. Like we trade with 80 banks globally. And he said to me in that very first meeting, we have identified this as an opportunity in terms of being the potential latent prospect for future alpha generation. So you guys had independently arrived at the same conclusions, which I was really refreshing. I've heard that a couple of times over the last 15 years, but that would be on one hand I could count because I think it's instructive because our experience with other asset consultants has been, oh, you're just a crazy Aussie shop. Like, how can you scale globally? I remember speaking to a sovereign wealth fund in 2016. I was running 300 million. And the deputy CIO of the sovereign wealth fund, who we have a very good relationship with today, said to me, Chris, I love this, but you'll never be able to run more than $1 billion. Fast forward today, not only do we run 15 billion, but our bond book with leverage is actually 30 billion today. And our returns in the last few years have been better than they were in those earlier years. We are much bigger and better and more capable and more effective. The efficacy of our trading is substantially improved from that smaller scale back in 2016. So, and the other thing I used to hear from asset consultants was, oh, you can't trade credit because it's liquid. You would have heard this, right?
Totally.
Yeah, credit markets freeze up. And this is such a myth, right? This is such BS. So it is true. So there's 7,000 investment grade bond issuers globally. And we currently only, in our active trading, allocate to 300 of them in terms of issuers, more securities. Those 300 issuers account for 54% of all IG bonds outstanding. So those 300 issuers are the mega caps. And in the equities lexicon, it would be like, could you trade Apple stock? March 2020, of course. 22, of course. April 25, of course. In 2008, of course. But could you trade a specky resources company or a micro cap that's a tech startup? No. And it's the same in credit, right? Could you trade triple B corporate IG in a lot of those markets? Probably not. Could you trade subordinated ABS and MBS? No. Can you trade subprime stuff? Not. But the high grade stuff there's always a bid offer.
Right.
And if you're contrarian in your use of liquidity, it's actually interesting in those dislocated markets. So April 2025, we traded 15 billion. We traded 11 billion of credit in the month of April 2025. And we heard the same old stories. Massive VAR shock, multi-standard deviation shock. We saw 13.5 percentage point intraday equity swings, the biggest swings since 2008. All the credit funds were saying the same things. Oh, we've got no liquidity. Oh, you can't trade. I had one client that came to me and said, I need 500 million. They desperately needed cash. T+2, bang, de minimis transaction costs. We gave it to them. So
this is the myth in your mind. If you're trading the mega caps.
But you guys got it instantaneously. Like your guys, the clarity of thought was super, empowering and I was happy to see, but other researchers has taken them like decades and they've got there, but it's been, we were the crazy Aussie shop. And it's kind of like, it's only true until you've, you're an overnight success, but really it's taken 15 years.
I like that saying. 20 years to be an overnight success.
So I think we are a little bit idiosyncratic. There's just no doubt about that. Like, to ventilate a few unusual features of our model, like we're not looking for swashbuckling, big personality, high hubris portfolio managers or trainers.
So that's not been an issue, like having such high turnover and working with the banks who know you might be just in it for sometimes a day or two, right?
So this is also like interesting, paradoxical. The traditional heuristic is like bond issuers and banks prefer, hold to maturity.
Buy and holds,
we get statistically over allocated in new issues all the time. And we get incredibly well treated by issuers because they have a more nuanced approach to the market. The way the issuers, and we spent 15 years educating the issuers, and we spent 15 years educating the street. So the 80 plus banks we deal with, their syndicate teams, their debt capital markets team. So would you prefer the hold to maturity ABC global bond manager out there that when the shit hits the fan in March 2020 is dumping your stock on the street? On the 9th of April, we bought 2 billion of credit on that day. Goldman Sachs did a survey of global insto clients a few days later that said 80% of global insto investors were de-risking or not adding to risk. No.
Right.
And that's what we do. When
so they know you're there as a contrarian.
I remember when UBS bought Credit Suisse, over that weekend, like UBS was a credit we traded massively. Credit Suisse was a credit we hated. So we put a blanket ban on Credit Suisse in May 2021. And one thing to understand about our process is liquidity is a condition precedent or sine qua non for everything we do. So we always need liquidity. And to always have liquidity, you really can't have much risk.
Yeah.
If there's any jump to default risk, you're not going to be able to trade. And so we do this maniacal due diligence on understanding the credits and making sure these business models are basically too big to fail and completely bulletproof. And in May 2021, our credit research team, and you guys have seen the coverage reports, they're often 60 pages long, said, hey, no more longs in Credit Suisse. We were shorting Credit Suisse in 2022. So that was in 21. We shorted them in 2022. They blew up in March 23. Over that weekend, the whole world thought that FINMA and the S&B had forced UBS, as they probably had, to buy Credit Suisse. And it was a dud trade. It was going to be terrible. Credit Suisse was toxic. We thought Credit Suisse was a dud investment bank. We actually didn't think there was anything massively wrong, but we don't like the tail risks in investment banks. We loved UBS. And our diligence was, this was like the greatest trade in history. Like my analyst said to me over the weekend, they're buying this, or on the Monday when they announced the transaction, they said, they're buying this 30 billion Swiss francs cheap. They said, this is massively equity positive, massively credit positive. They're taking out their number one competitor. They're becoming even more too big to fail. They're getting a 15 billion Swiss franc guarantee, loss indemnity from the Swiss state. They're getting 150 billion in cheap loans from the S&B. And this is like amazing. And yet on Monday, when they announced the deal, UBS's share price fell 16%. And their senior bond spreads blew to from 150 over bonds to 310 over bonds. Everyone in the world was selling UBS paper.
Right.
What did we do? We walked in on the Monday and Tuesday and bought 1 to 2 billion of UBS senior bonds. Weeks later, UBS wrote to us and they said, we think you triggered a global short squeeze in our paper. And thank you for the support because you're the only fund manager on the planet buying our bonds in this time of need. And we have done this, John, time and time again.
Build some credibility for the next time. And
when the shit hits the fan, we're the first guys you call. When you can't get that deal away, you need that cornerstone bid, you call us. When markets are fragile and nobody wants to put capital to work, you call us. And so because we're so inherently contrarian, issuers love that. And the other thing that issuers love is when we like an issuer, we support them all around the world in every global currency. And we support them up and down the capital stack. They're senior secured bonds, they're senior unsecured bonds, they're subordinated bonds, potentially they're AT1 hybrids. So yeah, the process is very different to the rest of the world. We're not buy to maintain. But we're very strategic.
Well, mate, that's our show for today. Remember, in your personal life and your investing life, keep breaking boundaries.
This podcast is intended for informational purposes only. The content provided within the podcast should not be construed as investment advice, research, or recommendation, solicitation, or offer for any specific Russell investment or other product, strategy, security, or service. The information does not take into account the investment objectives or circumstances of any particular investor and may not be appropriate for all investors. Any past performance results should not be seen as a guide to future return. All opinions presented are as of the date of recording and subject to change without notice. Information contained within the podcast is obtained from sources believed to be reliable but not guaranteed. Reliance upon the information provided in the podcast is at the sole discretion of the listener. The general information contained in this publication should not be acted upon without obtaining investment advice from a licensed professional. This podcast may involve discussions with non-Russell Investments personnel. The views and opinions expressed by non-affiliated personnel in this podcast are those of the speaker and do not reflect the policy or position of Russell Investments or any of its affiliates. This content should not be construed as recommendation or endorsements of any third-party manager featured on the podcast. Some of the portfolio managers or firms featured in the podcast may manage funds or accounts that are offered by Russell Investments, and they may be business relationships with Russell Investments or its affiliates. Neither Russell Investments nor any of its staff accepts any responsibility for or liability with respect to the information or opinions contained in this publication. In EMEA, this content is suitable for professional clients only. Capital at risk. Copyright 1995-2025 Russell Investments Group, LLC, all rights reserved.